Okay, guys, so I'm going to take you through my routine of what I do kind of on a daily basis, especially when the market is open. Now, the market has been open for a few hours now, and I want to caution everybody about trading in the early morning hours. Okay, you don't need to do that a lot of the times. I know that's what a lot of people do. You see that on TV. You don't really need to do that, especially when you are sticking to your principle, your guiding investing principles, and you're sticking with a core portfolio of stocks or just even indexes that you're tracking. Getting up early in the morning and trying to trade the opening, you can do that, but there's a lot of stress involved. It's just up to you whether or not you want to do that. So kind of what I do is I always walk through and I just check to see what my core portfolio is doing during the day. I'm checking the indexes, I'm checking the stocks, and just to see how they're doing. So Nvidia pretty flat, Apple pretty flat, and really what I'm looking for is large movements. So like 3% or more minimum. If they're in the 1 to 2% range, that is business as usual. There's nothing I really need to do. And at least on my immediate portfolio, not a lot I need to do. I can see the S&P is basically flat. NASDAQ is down a little bit and going down. Yeah, not a ton. Then what I do is I start checking kind of what's going on in what I call my watch list or my ancillary portfolio. So I've got my core portfolio here that's basically an index or multiple indexes and then a basket of stocks. For the criteria that I look at for stocks, I'm looking for 20% of year performers. And the way I do that is I can go to a site like Morningstar, and it amazes me how many of you guys don't check the past performance of stocks. Just blows my mind. And I know someone is going to tell me, oh, past performance doesn't guarantee future results. No, it doesn't guarantee future results, but it does indicate them. Okay. If you've had a stock that hasn't performed over the last 5 years, you shouldn't be buying it realistically, unless you've got a damn good reason. Or you can just do this and you can look at something like Apple where you can see, hey, the 5 year average is 22%. Okay, the 10-year average is almost 21. The 15-year average is 23.5%. Okay, that's insane. For 15 years, it's not that it's gotten 23% a year, but over that time, for over 15 years, you've averaged 23%. That means you're doubling your money quicker than every 5 years, which is insane for a stock. Most stocks don't do that. And again, this is for your core portfolio that you don't really mess with. Okay, you don't need to trade this. You can sit on this and let this work for you, but you need to find the stocks that are in that 20 plus percent per year average. And an easy way to do that is just to check here and see if they are. So we'll check another one. We'll say Walmart. Okay. And again, you just go here, you look at the trailing returns, and you see, hey, the 5 year average is good, but the 10 and the 15 year, that's really good for that industry, but it falls short of our 20% goal. Okay. For me, I look for 20% because I want to make my portfolio as automated as possible. I don't want to do a lot of trading. I want the market to do the work for me. But when I look at a stock like Apple, that does have these amazing trailing returns. This is a market beater. And that's what I'm looking for. Stocks that are not only have proven that they're a market beater, that have a history of proving it, but are likely to do it in the future. Okay, and this is where we can go back and say past performance does not guarantee future results, but it does indicate them. And that's what you want to remember. When we look at the graphs, we can see, hey, the S&P, the 10-year total return, 164%. But Apple, the 10-year total return, up 509%. Okay. That's a triple. It's more than a triple. And this is why I say it's an index beater. You don't really want to mess around with this. And look at this graph. There's not a ton of times that you really want to sell it. Sure, there's a drop here to here. I mean, this is a drop going from 174 to 137. Okay, yeah, if you were prescient enough to know that this was the peak and that you could go in and rebuy it, sure. I can tell you, when you start playing stocks like that, the worst thing that can happen is that you get it right the first time because then you think you can do it again and you think you can do it repeatedly, and you generally can't. It's easier just to hold this stock and then buy more when it sinks by this much. This is about, it's not even a 20% drop, to be honest with you. But when you're on these dips, you have all heard the thing about buy the dips. This is something I would buy. It was at 250, went down to a little under 200. Hey, that's a 20% drop. For Apple, that's a great buying signal because this is down 20%. You see that drop. This 197 to 165, that's not 20%. Here to here is not 20%. Here to here is not 20%. Here to here, that's just about 20%. Okay. And I bet you here to here is 20%. Yeah, that's a little bit more. The key thing is that for this no BS portfolio where you're just holding these positions, you're buying more. You're not actively buying and selling. These are not positions you want to actively buy and sell. Because if you're actively buying and selling, what's going to happen is you're going to miss out on this 509% gain because you're too busy screwing around with it. You're too busy trading it. Just sit on it. If you want to make a little bit more money, maybe you write some covered calls or something like that. But you really don't want to mess with this portfolio. Okay. Again, it's an index beater. 164 compared to 508%. It's triple the market. So the key thing is always go over here and just check the past returns of your stock. So we'll do another one, ExxonMobil. This is why I don't trade energy. Okay. It's just if you're not actively trading it, it becomes too much pain in the ass, and I don't want to work that much. Okay, yeah, the 5-year average looks pretty good, but the 10 years at 5%, the 15 years at 6%. And I can tell you, I've been working in the markets for 20 years. That's actually pretty average. If you're just doing a straight buy and hold, like you're just buying that stock and hanging on to it, that's about what you're going to get. And somebody's going to say, well, yeah, but ExxonMobil pays a dividend. That's great, man. Okay, so you get another 4% on the dividend. Okay, 4 plus 4 is 8, 8.5. It's not 20. Okay, it's not 20. And you could have this for diversification, but you're diversifying your returns away. Okay, you're making your returns worse. You don't need diversification is just a story made up by mutual fund companies and investment companies to sell more mutual funds and investments. Okay, I'm not saying you don't need to have a bunch of different investments. You just don't need to be over diversified. So whenever looking at a stock, just do yourself a favor. Always look at the past returns. Let's see, we can look at something. Let's look at something else that's everybody raves about, but that was probably garbage. Let's see here. I'll pick on SoFi. And here's the other thing. SoFi hasn't been around for 10 years, hasn't even been around for 5. I would not consider SoFi a piece of my core portfolios. It's not something I put a ton of money into it because it doesn't have a proven track record. Okay. I'm looking for things that have a proven track record that I can continue to bet on, that I can also sleep on, that I don't need to worry about. Apple is one of them. Okay. Apple is not a SoFi. This could play out to where you're making a huge return, sure, but it's not something you want to bet the farm on, and it's not something I would have as a core piece of my portfolio. It just doesn't have the long-term established track record of beating the index that I'm looking for. Okay, so going back here. So that's my core watch list. And then here's where I get into my secondary watch list. So this is things like Shopify, Mercado Libre. Not the biggest fan of Google. Don't ask me why. Sure, it beats the index, but I'd rather own Microsoft or Apple. I got a couple cybersecurity positions here, and a couple others like Trade Desk, Roblox, the list goes on. But you just simply have a list of stocks that you're constantly, I don't want to say you're constantly adding to, but you have enough conviction of to put them in your watch list. Here's a general rule of thumb that I go with when I want to deviate from my core portfolio to some other guy. Watch the stock, do yourself a favor. When you start looking at a stock, if it's not part of your core portfolio, watch it for 2 years. Okay. Watch it for 2 years. Don't trade it. Don't buy it. Don't sell it. Just watch it. Okay. You want to get familiar with the patterns of that particular stock. And the minimum time that's going to take is 2 years. Okay. It's not any quicker than that. You don't know what's going to happen with it. There's so many things that I could go into and explain about why you need to do this, but just watch it for 2 years. This will also, there's a side benefit to this, is that you're also going to develop discipline. Okay. You need to be able to buy a stock and not trade it. And one of the ways that you do that is by not buying the stock and just looking at it. Just get familiar with looking at it. I see too many people, especially guys, who will buy a stock and it'll be down a little bit, 90 days, 120 days into owning it, and they're like, "Oh, I'm going to cut my losses. I'm going to sell it." Why'd you buy it in the first place then? If you're going to cut out in 90 days to 120 days, dude, you don't have enough conviction to be buying that stock. You have no business buying. You want to, and I'm talking to investors. Okay, I'm not talking to traders. Traders, you're a different animal. I think you guys do a lot of work for not making that great a return. We could argue that point. It's up to you. Again, I want the market to do the work for me. Okay. I don't really like trading. It's too much stress, can't sleep, you're always thinking about the market, always watching it. It affects your relationships. Have the market do the work for you. Okay. Going back to the original point of always watching a stock for 2 years. I don't care what it is, especially if it's an IPO. Man, if it's an IPO, do not buy that bitch on day one. It's going to tank. Okay. All IPOs, the stock price within 3 to 9 months is realistically going to be lower than the day that it came out. Yeah, perfect example is Meta, Facebook. Okay, way back in the day. Came out in 2012. Okay, around, I think it was like $25, $30 a share. If you just wait just a couple months, look, 1 month later, $21. Okay, you're getting it for a third off. And this is Meta. This is Facebook. Everybody knew this was going to be a multi-billion-dollar company. It was pretty much guaranteed, written stone. And this thing dropped 30% from its IPO price. Okay, go a little farther. Hey, we're into August. We're at 18. Okay, I think it gets down to like 17 something. The chart's not bringing it up because it's only going by month. But the low point was like $17, which is almost half of what that thing debuted at. And this is Facebook. So when someone is buying an IPO on the day it comes out, I'm like, dude, is this bigger than Facebook? Is this a Facebook? Because even Facebook was subjected to this general rule of no, you're going to tank within 3 to 9 months. Okay, I cannot tell you how many IPOs. All of you that were buying SPACs in 2020 know what I'm talking about. If the SPAC is even around anymore, SPAC is also another red flag. Just stay away from that stuff. You got to wait until the company proves itself. If it's going to be a 10, 15 year or 20 year holding, you can miss the first 2 years. Okay. You can miss the first 2 years. It doesn't really matter. You can miss the first couple humps and then get in on a third or fourth one. And if it's going to prove itself, if it's going to be this type of company, you don't need to get in early. Okay. And that's the other myth I want to bust right now is getting in early. I myself, and I've seen so many people try to make money by getting in early. And then what happens is the company unleashes a shitty earnings report, or something happens with the company, or it loses funding, or something. It loses a main supplier, or a different competitor comes in. And if you just would have waited that 2 years, you could have weeded out all that crap. Okay, weeded out all that crap. So that's a general rule when you're looking at buying a new stock. Something that isn't established, something that doesn't have a proven track record. Just watch it for 2 years. And if you do that, you're going to get to know the patterns that stock does far better than if you just jump into it, only been watching it for a week or two. You're getting FOMO, thinking you're missing out on something. Trust me, if it's a great stock, you can literally buy it at any price. Okay, that's if it's a great stock. Good stocks, it's helpful to have timing, to have good timing. But if it's a great stock, you can buy it at any price. Again, let's go back to Apple. Even Meta. Hey, there's good timing here on Meta. Go back to Apple. Let's just look at the 10-year. Okay. And a lesson here too about getting in on all-time highs. All-time highs are repeatable event highs. You can always have brand new all-time highs. You never have new all-time lows. Okay. I want to say that again. You can never have new all-time lows. It's just not really possible unless the stock's really going in this year. And then something happened with the business model or you fucked up. You made a mistake. If you just keep buying along the way. If it's a great stock, again, you can buy it at any price. It doesn't matter if you buy it here. Hey, here's a new all-time high. You buy it here. Hey, here's a new all-time high. Here. It doesn't matter. Okay. There are some stocks you can literally buy at pretty much any price. and are going to appreciate in value. And those are the businesses that you want to look at. Those are the businesses that you want to make part of your core portfolio. All right, so enough of that. So let's go and do news comb. Okay, so I always do a news comb just looking for things. 80% of what comes up on here is bullshit. You don't need to really worry about it. And I'm going to walk you through that. So I go through the Wall Street Journal, I go through Barron's and Market Watch. Okay. And 80% of this is bullshit you can filter out. This whole section here, this opinion piece, you can filter that shit out. That's just someone's opinion. You don't need to know anything about that. Don't even waste your time with it. Let's see here. U.S. intelligence agencies to step up spying on Greenland. Has nothing to do with the market right now. Okay, that's news, or old, like I like to call it, because we already know this is happening. India and Pakistan getting into a fight. Nothing to do with the market. Don't need Vatican. Nothing to do with the market. This, nothing to do with the market. U.S. and Chinese officials meet for trade talks. This is just an article about them meeting. Nothing is resolved. You can ignore shit like that. Fight over heart rate. Ignore that. High school juniors with job offers. Who gives a shit? I'm happy for them, but I don't care. It has nothing to do with my core portfolio or with what's actually going on in the market today. Okay. Investors await Fed decision power marks. You can skip that too. Powell hasn't said anything yet. This is just an article anticipating you that something is going to come that isn't here yet. Tax Imperil by Republic. Again, you could maybe read this one because it's kind of meta focused. But this is also just, it's kind of bullshit. Disney plans new theme park in Abu Dhabi. If Disney isn't part of your core portfolio, you can skip that. You don't need to pay attention. You don't need to read articles about stocks that aren't in your core portfolio or aren't in your watch list. Okay. And just for shits and giggles, let's take a look. Does Disney meet our criteria? Is it an index beater? This is the first place you need to go. 5-year return, negative. 10-year return, negative. 15-year return, 8%. It doesn't meet any of our criteria. You don't need to be buying this. Sure, people like Disney, people like Star Wars. Is it a good investment? Off of these numbers, no. It has not proven itself. Okay, we don't need to mess with Disney. This podcast, yeah, maybe, but honestly, Wall Street Journal podcasts tend to suck. Investors bid farewell to Buffett? Maybe. Wall Street is watching this. If it says watching, this is just an article about someone's opinion. They're trying to take a guess on what's going to happen. It's not important. If you want to learn how to snag Southwest extra legroom seats, you can do that. Or you could actually take my travel hacking course where I teach you how to fly business class for free. Or you could read this article. Choice is yours. Columnists, again, this is not important. CEO says asteroid is coming to destroy America's businesses. It's like Zombieland. Like, you can worry about it, but there ain't nothing you can do about it, so don't worry about it. You can drink your weed now. Okay, great. I was terrible at money. My daughter should learn from my mistakes. Did she? Were you a responsible parent and forced her ass to learn? I don't know. It doesn't look like it. Again, not important. Hollywood tariff, not really important. Real ID deadline for traveling. That's important to me because I travel, but it's not newsworthy as far as your report goes. Look at this. We have eliminated so much of the Wall Street Journal. We have not even come to a relevant article. You may not even find a relevant article about your core portfolio of the market that you need on a daily basis for the Wall Street Journal. Okay, this is why I always make fun of it. EV sales grind to a halt. Okay, if you own Tesla, which I think you should, there's a lot of reasons for that. A lot of people be like, oh, BYD is leading the charge and Tesla's losing ground and stuff like that. Dude, it doesn't matter. Tesla is the #2 electric vehicle manufacturer in the world. Okay. People forget there's room for more than one winner. Okay. You have a Google and a Microsoft. You have a Visa and a MasterCard and an American Express. You have a Home Depot and a Lowe's. Okay. You have a Walmart and an Amazon and a Costco. There's generally room for more than one winner. It doesn't mean you just need to go with the person that is in the lead, especially if it's a Chinese company. There's tons of problems with that. Make another video about that later. But maybe you read this one since we haven't read anything else. We'll come back to this and see if it's important. Road warriors beware. Business travel takes a hit. Not important to our core portfolio or what we're trying to do. You can eliminate all this stuff. Save yourself some time. Who really cares? You're not investing in private equity. This article also probably not important to you. Sports. You can read it if you like sports, but we're on business. We're on a business mind right now. We don't need to be reading about sports. Sources for cash, kind of depressing. Again, war on Ukraine, very sad, shouldn't be going on. We need to keep our minds laser focused on what we're trying to accomplish for the day. Okay, we're trying to keep, our mental focus so that we can just do our business and investments and get on with our day. Venezuelan opposition, again, don't need this. I don't care about other people's refrigerator obsessions. Why would I care about that? I don't even know why that's in the Wall Street Journal. This person died. Don't know who that is. I apologize. $160,000 playroom. I would rather put 160 grand in the market than make a playroom for the kids I don't have. It's not important to me. Let's see. Is there anything else? Pros and cons to 529 plans for colleges. Dude, I'll do a video on that. 529 plans suck. Don't buy them. Very few people should buy those. Should you buy a stock targeted by an activist investor? If we're following the 2-year rule, where we're not buying stocks that we haven't been watching for 2 years, that's actually probably not important. Let's see. None of this is important. Okay, let's see. Slow news day. Not really important to our core portfolio, maybe important to the market. This is definitely not important, not important, not important, not important. I'm not a Boston homeowner. I don't care. I don't care about California, an $8.5 million California home. The EU is doing a deal with Singapore. Not important to me. I can tell from this title, this is an opinion article. Again, we don't need opinion articles. Article on TikTok. TikTok is a foreign-based company. It's not a great performer anyway. I stay away with it. It's not a part of my core portfolio. Again, I'll probably do a whole video about why I don't personally invest in international companies. I don't think it's worth the extra risk. You don't need it for diversification. Most international companies and countries as a whole do not outperform the US over a long term. So not really. Big marketers like MasterCard, PepsiCo, and Nissan are rethinking pride marketing. I don't give a shit about that. It's not because hey man, I'm all prideful and everything like that. But this has nothing to do with my business. They're rethinking their marketing strategy. It has nothing to do with their profits or anything like that. There's no numbers in that article. I don't even have to go to it. Don't give a shit about Live Nation. IBM, never buy that piece of shit as a stock. Okay, it's a terrible, terrible stock. I'll just show you. IBM does not meet our criteria. Over 10 years, it's up 51%, meaning it's averaged less than 5% a year. Again, if you're curious about a stock, you just go here. Check the past performance. It doesn't mean that's what it's going to do in the future, but just check it. Okay, you got to find out if it's worthwhile investing in. No, it's not. Doesn't even come close to hitting double digits. Forget that mess. United Health. Let's check it out. I didn't even see what the article said. We'll just check it out. Oops. We need United Health Group. That's not too bad. But you know what I'd rather have? Eli Lilly, baby. You know why? Because it does meet our criteria. 5-year average, 38% and change. 10-year, 27. 15-year, 23.5. I'll take that over United Health. Back to the news. Cracker Barrel. Fuck no, I'm not buying that shit. AI agents are learning how to collaborate. Companies need to work with, again, not really. I mean, yeah, you could read it, but it's not really important. We don't care about this one either. Risk and compliance. Yeah, again, this is old news. U.S. urges breakup of Google ad business. If you've been watching the news, you've already known that. You've seen that before. You don't need to reread an article you've probably already read before, or at least see the headline of. This has been in the news every day for the past 2 weeks. UBS, garbage bank, never buy them. Again, not important to what you're doing. Again, Wall Street is watching. Okay, this is an article about someone's opinion about something that may be important in the market. Okay, shipping indexes. And again, this is somebody anticipating something is going to happen, not something that you can confirm, not something that you can verify. I'm not even going to the article. DHL unit requires. Now, if you're buying DHL, you could maybe read this. Does DHL meet our criteria? What's the ticker for DHL? I actually don't even know. Let's see. United, never buy an airline. Never buy an airline. Other than Tesla, you don't buy an automotive company. You don't buy Ford. You don't buy GM. You don't buy. Okay, you just don't. Let's see. This is Orsted. Don't even know who that is. what company that is. Sitting in Amazon is the right place to host a climate conference. Again, doesn't really matter. Trump is threatening Big Pharma with tariffs. He hasn't done it yet. Again, it's not an actionable news item. You're looking for actionable news items. Apple won't be able to avoid price hikes for long. Apple's in my portfolio. I probably want to take a look at this article. You're more like Warren Buffett than you think. I don't think so. I might read this just for shits and giggles later. Again, articles to just flat out avoid and never look at. Something like these. These stocks are moving the most today. Who cares about today? I mean, today is important, don't get me wrong. But when you're looking at stocks, you don't want to look at just what's happening today. Who cares if they're moving the most today? I want to know what they've done in the last 10 years. I want to know what they've done over the last 15 years. Articles like this, they're just bait. Of course, this is Barron's. Barron's is notorious for this. I'll show you Barron's in a second. Let's go back down here. I think we're pretty much done with Wall Street Journal. What was that? 3 articles out of the Wall Street Journal that were maybe important? Flow News Day. Let's see. Trump can recover from the tariff mess. Here's the pivot. Again, that's someone's opinion, not actually something that's going to happen. Alibaba, Baidu stocks fall. Again, stay away from China. All right. So what we're going to do is, because this is Market Watch and a bunch of other different websites, let's go to Barron's, because Barron's is my favorite one to pick on. Because in my opinion, out of the 3, Barron's actually has the worst reporting. Stocks are rising on trade talk optimism. Let's really check that out. Are they? Let's see. We're up 0.06% today. Stocks are rising based on trade. This is a live feed. What levels are they rising to? This is just clickbait. Fed's going to cut rates today. No kidding. Marvel stock falls sharply. Disney soars after a beat. It's about a theme park. Let's just pick on Barron's right now. Disney soars. I bet. Okay, it's up 10%. But again, Disney is not one of those stocks that meets our criteria. Great that the stock is doing well, but if you don't own it, you don't need to be reading about it. If it's not hitting your criteria and a stock you want to invest in, ignore that article. Most of this news comb you're going to do in an hour. Let's see. Air traffic controllers, not important to the market. There's another one. Tesla stock is rising. It might not be ready for self-driving taxis. Whatever. Uber stock tumbles. Nvidia stock gains. See, these are all just headlines. They're not telling you anything about the long-term trajectory of the business. Okay, it's all about what's going on today. Remember, a great stock you can buy at any price, generally. Bitcoin rises. You know what? We're just going to... here's a couple that I'll pick on too. Okay, energy has been hit hard. Chevron can bounce back. This is an opinion article written by a reporter. Okay, it probably doesn't say anything about what Chevron is doing to bounce back, what actions the business is actually taking. Okay, this is someone's opinion. This is Teresa Rivas. This is her opinion. This is all this is. Does Chevron meet our criteria? CVX. No, it doesn't. We can ignore that article. Okay. Let's go to Market Watch. Okay. I love these articles. Stock market reacts. Where's the reaction? We're here. I mean, here's the other thing. Remember to look at the scale of the stock chart. Okay. We went from 5,600 earlier in the day down to, okay, this is a 30 point drop. That's nothing. That's any given Tuesday. That's not a big enough drop to really be worried about or anything like that. So when you read the news for a long enough period of time, you'll realize there are certain patterns, reporting patterns that news agencies use to keep you interested. Like, things like this. Stock market reacts. It's not really reacting. The Disney soars one, I'm surprised that Disney wasn't up like 3 or 4%. Because it could be like, Disney soars, blah, blah, blah. And I look at the chart and I was like, dude, the thing's up like 3%. It's up 10, which is, I wouldn't call it soaring. Soaring to me is 20 or 30%, but 10% for Disney is a decent move. All right, let's go through this. The investors await first Fed decision. Wait for the decision to come out, and we probably know what it's going to be. We're probably just going to hold steady. I doubt we're going to get a rate cut. And even if we do, that possibility is kind of priced into the market already because we're expecting one not in May, but in June. Trump administration officials, unless they can tell you what actually happened in that meeting or what's going to happen in that meeting, you don't need to read that. India and Pakistan, no. Maybe this article about Buffett. Um, you could maybe read this because Amazon and Tesla are in my core portfolio that I like. Here's one on Nvidia. This is probably an article you could reach. Again, a Disney one. Don't need to worry about it. Again, if Taiwan Semiconductor is not in your core portfolio, let's check it. It's getting there. It doesn't have that 10-year average we're looking for, but it's getting there. You got some additional risk with Taiwan Semiconductor, obviously, because it's based out of Taiwan, and you've got the whole China go to war thing over it. So I don't know. I stay away from it, but it could be a winner. I don't know if the gain is enough for me to offset one of my other core holdings, or for me to take a position in it, though. There's other places I would go. Weight Watchers was bankrupt. Again, we're not investing in Weight Watchers. Real estate. I love these real estate articles because I generally don't like real estate as an investment. I think stocks are way better, but time for another video. Moneyest. Ugh. I'm gonna make a whole video on him. Yeah. He gives okay investment advice, but I wouldn't take his advice. I've been doing this for 20 years. So I would not take his advice. United, again, never buy an airline. Again, here's another Real ID article. There was another one in the Wall Street Journal. That's one of the reporting patterns you'll begin to see. You'll see that if there's an article in the Wall Street Journal, depending on what it is, you'll find a duplicate on Barron's, you'll find a duplicate on MarketWatch, because different newspapers have to cover the same news items, and so it's just the same article over and over again. Challenger property tax bill, sure, you could look at that. Novo Nordisk, not part of my core. Uber, not part of my core. Apple is. Marvel, maybe. CrowdStrike is in my ancillary stuff. So this is an article that I would read. We'll just go through this. Okay. Obviously, AI is becoming a big factor in the market, and CrowdStrike lays off 500. And the latest example of how AI is costing people their jobs. Let's see. It's cutting 5% of its workforce. Okay, so not a ton, but just trimming some positions because of the AI stuff. Let's see if there's anything important. Let's see. Gets rid of 500 out of 10,000 employees. And here's the thing about when companies fire people like this, they're going to hire people in other positions. Yes, AI is replacing some jobs, eliminating them, I should say, but the company is going to open up other positions because of AI. Okay, you always want to take that into an account. And if it's 5% of the workforce, it's not bad. Now, if it was firing 20 or 30% of the workforce, or the majority of its workforce, like Twitter did, that's something that's a little bit more newsworthy. A quick tip, whenever I'm doing an article, if I just want to scan through it really quickly, here's a trick that I do. I look for the numbers, okay? I'm looking to see what revenue growth was. I'm looking to see what the growth in the profit margin was. If I don't see numbers, it's not that it's not important, but that's really what I'm looking for, because I'm looking for data to confirm my stock choices. I'm looking to see, hey, Apple profit margins either went down and they went up, and they went up by a certain percentage, or went down by a certain percentage. Okay. So if you're not seeing a lot of numbers in the articles, I don't know. Let's see here. Yeah, like it's talking about how CrowdStrike made a decision to embrace mobile apps. Fortuitous. Blah 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 blah. Nope. Nothing really here. Hold on. You got some. Yeah, this is about Manpower, which is, a temp agency kind of thing. So even this article, it is focused on one of our ancillary stocks. Not a ton of information in there. It's really just an article about the layoffs, 5% of the workforce. Not really important. You can wipe that from your memory. Personal finance. Yeah, again, I don't care about what's streaming on Netflix. US is on the precipice of recession. Here's the thing. If we have a recession, great. You know why? Because we go through a little bit of pain and then we shoot to the moon. Okay. We have, I was just talking with a group of people about this earlier today. A recession may last 3 months, 6 months. It can't last 3 months, but 6 months, 9 months. Let's say it lasts a year. Typically, after a recession, we have a bull market that lasts 3 to 4 years. I will take the 1 year down for the 3 to 4 years up. Like, and you need that reset button occasionally because if you don't, you can't go up forever. And if you go up for 10 or 12 years, you're going to have a harder drop down than if you go up for 6 or 7 years, have a little bit of a reset and then go back up. So it's just part of the game. Okay. If you're a 20-year investor, 30-year investor, 50-year investor, get used to recessions. It's not a big of a deal. College decision day is coming. Don't care. Trump's picks or Social Security Commissioner. Don't care. I don't have Social Security benefits right now. Blah blah blah. Yeah, none of these are important for what I'm looking at. Mortgage rates dip. I mean, sure. Again, if it's not affecting the market in its essence, if it's not part of your core portfolio, don't bother with the articles. And the other reason I say that is because I used to read a bunch of newspapers every day. And I had to stop doing it because the news was so depressing that it was affecting me. Okay. I had to stop doing it. And so now I just do a news scan and my life is a lot better. Yours should be too. Don't focus so much on the news. Okay. So that's the news watch, the news comb. Again, I go through that pretty quickly. I'll do another one again tomorrow. But again, don't pay so much attention to them. You really don't. It'll just drive you crazy. All right, what else? Here's something else you need to check on. Always check your horoscope for the day. I know it sounds funny, but honestly, always check your horoscope for today. And the main reason being is that there's honestly been some stuff on here where it very clearly told me not to trade. Like it was plain as day. It was like, hey, don't buy that shit. And generally it's right. So I'll get into that later on more. But check your horoscope for the day. Trust me. All right, what else? Oh, so I like checking the biggest gainers and losers for the day. Okay. Because this is a really, so you go to Yahoo Finance and you click on these top gainers, top losers, because this is a really good way for me to see if I maybe missed something. Okay. Because the news doesn't always do a great job at reporting everything. And I just like going here because there could have been something that's happening with one of my ancillary stocks, like Doximity or Planeteer or something like that, that I missed that caused it to have a huge run up or a huge drop. I'm looking at and usually what I'm looking for is movements of more than 10%. And here's the other thing. Stocks move in the long term by hundreds and thousands of percents. A movement of 3 or 4% in any given day is not important to me. I want the big swings because that's going to indicate more to me than these little run ups. If it's moving up 1%, 2%, that's normal. Let's see, there's nothing here. There's nothing here that's in my range that I'm looking at or no stocks that I'm interested in. So let me check the losers. Let's see, Marvel. Okay, I want to do some checking on that because we did see a couple things about Marvel. Google is also down. That's a pretty big, and not that it's in my core portfolio, but that's a pretty decent drop for Google. Usually Google doesn't drop by 6% a day. So let's check out and see what's going on with Marvel. Okay. So I can tell you right now from this graph, Marvel isn't doing all that great. And it's not because it's got this precipitous drop right here. It's mostly because it's now hitting really low points compared to its long-term averages. So you can see back here, back in 23, November 23, it's trading at those levels again, which my gut tells me this maybe has farther to drop. It may not. I love this. Kramer. Ooh, Kramer, 4 days ago. Lightning round. Marvel Technology is a buy. Let's see what his timing is like. Ouch. Dang, Kramer. I'll pick on Kramer a little bit. Okay, so if you bought it 4 days ago, so you bought somewhere around 62. Okay, now it's at 54. Okay. So this is another rule about buying stocks. Whenever you're buying a new stock, never put a ton of money into it. Okay. Because let's just say you want to put $2,000 into Marvel. Put 250, maybe 500, because you never know when something like this is going to happen. Okay. You could pick up more shares at a much better price. Let's see what happened with Marvel. Let's see. Market uncertainty. Okay, so its loss status is a favored play on AI. Let's see. Let's figure out why. Okay, that's set to add to a 40. This is important. That's set to add to a 45% this year, a 45% drop this year. Okay, which is what we're seeing. Oops, 45% drop this year. So from here to here. Okay. So this is also something you learn being in the markets and watching the markets for a long time, especially with tech companies. Okay. Tech companies can fall 80 to 90% before they begin to rebound. I'm not saying that Marvel's going to drop that much, but if we look at it from 124 and we go down to 54, okay, I mean, that's a significant drop. Let's just figure that out real quick. It's a 56% drop. Okay, just since January. I wouldn't be surprised if it goes lower. Let's go back to the article. Okay, let's see. So poorly received guidance. So basically they're saying, hey, we think we're going to make this much money this year, and the market didn't like it. Let's see. Could lose a deal with Amazon. Amazon's a Amazon's a picky bitch, man. They will cut people off like crazy. If you see something that says, "Hey, Amazon made this deal with this company. It's valued at $2 billion, or they invested $5 billion in this company," that doesn't mean that company is going to be successful. Amazon makes so much money, they can do that. They can throw away $5 billion on a maybe, and they do it all the time. Let's see. Okay, so it looks like they lost a contract to a Taiwanese competitor. Ouch! 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 Okay, another thing. So this guy, okay, analysts. Oof, analysts. Analysts just have very expensive opinions. I cannot say that enough. Just because an analyst says something doesn't make it right. If anything, because an analyst has a price target on there, frequently means that it's going to be wrong. And analysts are just very educated opinions. It's not hard facts, it's not hard data. It doesn't mean that that's what's going to happen. Analysts are just very educated opinions. Okay. They have nothing to do with that business. They have no control over it. Especially, let's see, William Blair. Honestly, if he's not working for JP Morgan or Goldman, I honestly don't pay attention to it. And it's not because I like JP Morgan Goldman, it's just that they have some of the best analysts. Okay. Analysts to almost never pay attention to. Citigroup, Bank of America, Wells Fargo, Credit Suisse, and Deutsche Bank. If an analyst is reporting from any one of those banks, throw it away. It does not mean anything. Okay. Sure, they're great people, but I've just noticed in 20 years of reading the news and the history, those five banks and a couple others really aren't that great at their analyst predictions. JP Morgan, Goldman Sachs. If that analyst is being quoted, pay attention to it. Okay, let's see. So here's the thing. This can be, if you're looking at buying Marvel, this is a wait and see moment. Yeah. You don't need to buy this right now. It's such a huge drop. And again, I know just from watching technology stocks, this is down 50%, 56%. It could drop 60 or 70% before it really starts to rebound. And also, obviously, this is not, I don't even have to check. I mean, we will, but we don't have to check. It is not meeting our criteria for the long term. This is definitely not going to be one of our key portfolio pieces. These numbers probably need to be updated because the 10-year on this bitch is not 16. It's not an average of 6%. It could be because it's way down here. Yeah, never mind. The 5 is like a really like a wait and see approach. It looks like they're losing contracts, and I don't know if that's due to a competitive advantage or They just happen to lose that contract and they're going to get others. But Amazon is a pretty big, here's the thing, they're artificial chip manufacturer. They need customers with deep pockets. That means Amazon. So if they just lost a customer like Amazon, that's why the stock's getting hit today hard. All right, last thing we're going to check just on our daily checklist, we need to check crypto. Just see what Bitcoin's doing. Okay, Bitcoin's moving a little bit up. It's at 97, up 1,000% over 5 years. So by the way, I cannot count how many banks have a price target of Bitcoin hitting 1 million per coin by the year 2050, or sorry, not 2050, 2030, or a little bit beyond. So many. BlackRock, Fidelity, Bank of America, I think issued a report. Wells Fargo, I think issued a report. I know I said don't pay attention to those banks, but now I can use that data to support my own conclusions, which I love to do. The point is that Bitcoin has a future. Bitcoin has a future. Just going on record and saying that now. That future might expire at some point, but Bitcoin has a future.